What is edge computing? Edge computing is a distributed paradigm for computation and data storage closer to data generating sources. That means that the data is being acquired, aggregated, processed and analyzed closer to the edge, like where the data is really produced, and you have so-called edge devices, edge servers, which make up the edge network, and from the edge only the relevant and important data is being sent up to the cloud. With this new paradigm, you can enable a variety of IoT applications, Internet of Things applications, in a more efficient way. So in this module, we're going to learn that edge computing is not only necessary from a technological or technical point of view, but also from an economic point of view, because you can lower latency times and you can also reduce the load times, which enables real-time on-site decision-making for certain applications. So this is a pretty new and interesting technology which holds great promises. And during this module, we'll discover what applications are based on edge computing and which new ones will arrive soon. Let's have a look at the edge computing infrastructure. So in general, we can see three different levels within the edge computing infrastructure. On the bottom, you have the edge devices. In the middle, you have the edge processing infrastructure, like the edge server. And then on the top, you have the cloud or on-premise data centers. Let's start at the bottom. Here you have different devices which are all producing a lot of data. These can be heating systems, self-driving cars, robots, wind turbines, the grid, or many other measurement instruments. So they constantly in real time are producing data and send these data to the edge servers. In these edge servers, you have real-time data processing, you can do basic analytics, data caching, buffering, optimization, and already can implement machine-to-machine communication on a local level. The very important thing is that not all of this data which has been produced locally is being sent up to the cloud, but rather being kept on the edge server, and from there you can program which data is relevant and is really continued to be sent up to the cloud or an on-premise data center. So you collect all the relevant data in the cloud and there you store it and can, for example, apply machine learning algorithms to automatically execute on certain tasks. The benefits of this infrastructure are twofold. First, you have lower latency times. For example, if you take the example of the robot arm in the bottom, the robot arm needs to react very, very fast if something is not right. Imagine there is a technical defect in the robot arm and it takes 1.5 seconds until the data is being sent to the cloud, processed and sent back. But if this is happening on a local, on the edge basis, you can reduce the latency times to milliseconds and avoid damage. The same is true when it comes to data storage, because you have to pay on your cloud provider for the amount of data you're storing there. And if you reduce the amount of data storage up there, you also have lower costs. So basically, edge computing is enabling you to reduce latency times, to operate your devices in a more efficient way, but also to save on cloud storage costs. So let's talk about the socio-economic implications of edge computing. So with the explosion of data and real-time applications, a new computing infrastructure is evolving. It's estimated that in 2025, approximately 30% of all generated data will be real-time data, and that the number of connected devices will rise from 20 billion in 2020 to about 41 billion in 2025. So you see, the world gets increasingly connected And all of these devices are producing a lot of data, but also what kind of data we are producing with humans is accelerating on an exponential rate. And therefore, today's data centers and data farms get already to their limits. So you have these limited storage capacities and also the requirements towards low latency and super fast reaction times, which will result in an increasing demand for edge computing providers and edge computing applications. If you think about self-driving cars, for example, which need to react in nanoseconds to avoid damage, or decentralized energy systems who are like producing, monitoring the weather, selling the electricity instantly. It takes too long to send all of this data to the cloud and back and then react. So all of these applications need near real-time edge computing infrastructure. But edge computing also has downsides, as you can imagine, as it is with many technologies. It's enabling more surveillance, so the more and more connected devices we have, the more data is being generated, and especially when privacy concerns are not taken seriously, these offers great opportunities for surveillance as well. And another important thing to consider is that if you compare a cloud infrastructure with an edge computing infrastructure, usually the cloud infrastructure is managed in a highly secure professional environment by big tech companies, while edge computing infrastructures are built independently from these tech providers. And once they are done not properly or not in a 100% secure way, they offer a vector for hacker attacks. So it's very important to also to build up the edge computing infrastructure before data gets sent to the cloud in a very secure way, because otherwise hackers and other malicious actors can also attack this kind of sensible edge computing infrastructures we're going to build in the next years to come. So what real world applications within edge computing are already existing today, and what's expected to come in the future? So in general, there are multiple industries affected by this new computing paradigm. For example, traffic management systems where you need real-time data to react instantly, public transit systems, the same, retail applications, as you will get to know in a second, industrial processes for monitoring and also predictive maintenance. So even being able to react before certain things happening. Manufacturing to keep the production up to speed and also avoid downtimes. Agriculture, as we saw in the previous video. And in general, everything related to security and worker safety, where you need to protect people and react instantly if certain things are diverging from the norm. In this slide, I listed 6 examples, 3 edge computing examples which we already have today, and 3 which will come in the near future. Today, when you think about automated warehouses, you have multiple robots driving around these warehouses, and they communicate with each other on a machine-to-machine basis and need to do this in a very fast and efficient time. And there's no need to collect all the data all the time, send it to the cloud and back. So this is typically done on a local basis via edge computing. The same is true for digital twins, especially in the manufacturing industry. Many companies are building so-called digital twins, which are a digital representation of a physical good. And if you, for example, turn the physical good, the digital good needs to, or the digital representation needs to react in real time to have an authentic experience. And this is also where edge computing is coming in. And these kind of digital twins, they produce an enormous amount of data. So it would be very expensive to store all of the data in the cloud. So these companies rather calculate and store the data on a local basis. Decentralized energy systems, which are becoming more and more important, as we learned in the climate tech module. Wind energy turbines, solar modules, batteries, charging stations, electric cars. They are all reacting based on weather patterns, if the sun is shining, if the wind is blowing, and therefore need also to react in real time to production changes, to consumption changes, and so on. And with edge computing, you can also increase the security on site if you lose the internet connection to the cloud, for example. So here, edge computing is also adding an additional layer of security and safety. Looking at the future, augmented reality is going to be a super interesting use case for edge computing. Some of you might remember Pokemon Go, where you could like hunt Pokemons with your smartphones. And there will be more and more applications coming up in augmented reality. And here as well, you need data to be processed on a local basis, in this case, really on the edge of your smartphone, to react pretty fast, and then also provide the user of an app, for example, an authentic experience. Another use case is going to be medical surveillance. Coming out of the COVID pandemic, there are multiple companies working on air ventilation monitoring systems who can detect if there's a certain amount of bacteria or viruses within the air, and they can automatically trigger an alarm to warn people within the room to leave, or especially in public places like airports or train stations. It's going to become super crucial to collect data in real time, process it very fast, and then also execute, for example, giving alarm to people. And last but not least, autonomous vehicles. These are basically computers on wheels which produce an enormous amount of data, and especially out of security concerns, they also need to react in real time or in nanoseconds to avoid accidents and also protect passengers. So as you can see, edge computing is a super fascinating technology. There are multiple applications already here today, and even more coming in the future. So for you as an expo investor, it's crucial to keep an eye on this technology, and also always monitor what companies are active in the field and what applications are coming up. And in the next lesson, we are going to speak about the investment opportunity within edge computing. Let's have a look at the investment opportunity within the edge computing market. If you look at the graph, you see that in the year 2021, the overall market capitalization within the edge computing industry was about $36 billion. This size is expected to grow to $87.1 billion in the year 2026. Which equals a compound annual growth rate of 19%. So there's a lot of growth ahead in edge computing. And here on the side, I listed some reasons why this is the case, and also some challenges which could hinder the market growth of edge computing. In general, the COVID-19 pandemic boosted the demand for edge computing because the data traffic all over the world was increasing heavily. People were sent home from the office, went into the home office, but still had to talk to their colleagues on online conferences, and these led to an increasing demand for data, and especially data traffic all over the world. Also, like in the manufacturing industry, in the automotive industry, the companies had to send home their workers, but implemented remote monitoring processes at the same time, so they could keep up the production of their products. Furthermore, there is rising awareness of edge computing, especially in the US and the Asia Pacific region. While in the US, companies see the benefits of lower latency times and also lower costs for storage in the cloud, in the Asia Pacific region, companies in general are moving over their on-premise infrastructure towards the cloud and at the same time implement edge computing architectures. But there are also some challenges ahead of the edge computing industry. One of it is that there are high initial upfront costs like CapEx if you want to implement edge computing. Netflix, for example, in the year 2018 decided not to invest or not to implement edge computing because they said the investment costs are too high, and from an economic point of view, it's not justifiable. So they rather lower the network performance or the quality of the video stream instead of building edge computing centers closer to their customers. Another challenge is also that the technology is rather new and you have a lack of skilled workers. So while the cloud computing market is very mature and can guarantee super high uptimes, this is not the case in the edge computing market, and many companies are a bit concerned and reluctant to invest in it just yet because they see the lack of skilled workers within this industry. But in general, looking at the projected growth, this is a very interesting industry to play in as an investor. And this trend in edge computing adoption is also mainly driven by the trends in autonomous drivings and the rising installations of decentralized energy systems like wind, solar, batteries, and so on. And so it's really crucial to keep an eye on this market and also think about companies and products to invest in edge computing. And in the next lesson, I'm going to show you both growth and value stocks you can invest in. Let's have a look at value and growth stocks within the edge computing industry. Let's start with value stocks on the top. Again, here is to name Microsoft, which is already a leading provider of cloud computing solutions. Now Microsoft is also entering the edge computing market and wants to offer its customers to easily combine the already existing cloud computing infrastructure and expand it with edge computing offerings. As we saw in an earlier video about agriculture, they are already active with projects like FarmBeats, and most likely will become and stay a dominant player within both the cloud but also the edge computing market. Dell is a very interesting value stock as well, since they are going heavily into edge computing, and their CEO recently said that edge is the new cloud, and they want to be a front runner when it comes to providing high-end hardware to build up edge computing infrastructure systems. Looking at growth stocks, you have Cloudflare, which can be seen as the leading provider of software infrastructure when it comes to edge computing. They offer content distribution networks, internet security software, and have a comparably small market capitalization with 30 billion compared to the $1 trillion market cap of Microsoft or other cloud providers like Amazon or Salesforce, for example. Furthermore, Micron Technology is a hardware company, which is one of the four largest manufacturers of semiconductors, and they are focusing on computer memory and data storage, and currently have a market cap at about $100 billion, which also is not that large if you compare it with competitors like Nvidia, which currently has a market cap around like $600 billion. So as mentioned earlier in this module, the edge computing industry is super fast growing, super fascinating to look at. And as always, this is for educational purposes only. Do your own research, your own homework before you decide in which company to invest in. And I want to wish you good luck trading and investing, and have fun with the quiz which is following in this lesson. How to find stocks the easy way, stock screening. In this lesson, I want to briefly explain you how to find interesting companies and what platforms are out there to actually find them. One of the most common ones, which I personally also use, is finviz.com, but there are other platforms like Yahoo Finance, Bloomberg, or Finanzen.net for German-speaking areas. And in this section, I want to briefly show you Finviz and how to navigate within the platform. So this is the homepage of Finviz. Here you see top gainers, top losers, different indices, and so on. So to navigate and find interesting companies, either you can search for them directly here, like if we say Microsoft, for example, you can just type it in and then you get all the ratios for Microsoft. Or another very useful possibility within Finviz is this screener here. So here in the screener, you have multiple filters to apply, for example, on which exchange the company is listed, what's the market capitalization, is it rather a small company, is it a large, is it a mega company, do they pay dividends, when they went public with the IPO, and so on and so forth. And in our case, since we deal with exponential technology, here you can choose a sector. And if we look at technology, you have subcategories within the industry, you know, from software applications, software infrastructure, and so on. And let's choose solar, since we've spoken about many climate tech companies. Here we find Solar Edge, which was also presented as one of our growth stocks. And there for Solar Edge, you have the chart where you see how the price was developing over history. You can choose between daily, weekly, and monthly. And you also have the most important ratios, income, sales, price to earnings, price to sales, and so on, previous performance. And some of these ratios, which are shown here on Finviz, we're going to cover in this module in depth. And so you're really equipped with the right skills to make smart decisions by choosing the companies and know how to read all of these ratios. Platforms for technical analysis. In this lesson, I want to briefly explain you how to use platforms to do technical analysis and come up with a decision if it's a good timing to invest in a company or get into the market. Usually I approach it in 3 steps. I visualize the price performance over history from a certain company or a market. I analyze, I apply ratios, tools which are available on these technical analysis platforms, and then I make a decision if I should buy, sell, or just hold a certain assets or do nothing if the signal is unclear. The most common platform is TradingView, which I personally use a lot. And there are other platforms like StockRover, Metastock, or Scans. And in this lesson, I want to briefly introduce you to TradingView. So if we have a look at TradingView, you have common assets here like Bitcoin, Tesla, and Apple. And when you scroll down, you see how TradingView works, and it's like a social trading, social investing platform. So you have so-called snaps, which are news in certain industries, and then you have ideas which have been created and shared by other traders and investors on the platform. You have the most common indices, and you can choose between indices and other assets up here. You have ideas to crypto, commodities, stocks, and so on. And you also have breaking news if some news come out with influence the markets. Let's have a look and check out, for example, Microsoft. So you can type it in here, Microsoft, and you see a visualization of the price development of Microsoft. So starting on the top, this is a daily resolution. So one candlestick, this is a so-called candlestick, is representing one day of trading. You can choose between the resolution from a daily, weekly, even a monthly resolution. The more long-term orientated you are, the higher the lower the resolution can be. Or if you say on the contrary, I'm a trader, I'm a day trader, then you would more look at like 15-minute data make up or to realize sell-offs, buy and sell later on after a couple of hours. I usually start by looking at the daily resolution to get the big picture how certain assets were developing. Here in the case of Microsoft, we see that the price development over the last years was pretty positive. Here you see the timeline on the x-axis, and here on the y-axis you see the price development. So Microsoft back in 2017 was at about $60 per share and rose up to over 300 in 2021. Now there was a bit of a sell-off and we are just below $300 again. TradingView is great to visualize this and give you a hint if certain assets are already in bubble territory or they sold off, and make it easier for you to decide if you want to buy, sell or hold certain assets. I just want to share with you two functionalities within TradingView, but the tool is very expansive and you can play around for hours with certain tools and ratios. But easy ones I use very often are here with a trend line. You can start by just drawing a trend line here and say, okay, this is the price where it moved on average. And you see currently we're below this trend line, which would be a signal for you to actually buy or really consider getting into the asset. And here you see we moved above the trend line, which symbolized that certain stocks have been overbought. But this trend line, of course, is like you can choose if it's too high, if it's too low. But usually you take the average of the price movement and then come up with an insight. Another very interesting thing you can do with TradingView is to compare companies. So if you say you're not sure if you want to invest in Microsoft or Apple, you can also compare and type in Apple. And then you see the price development of both companies. So this one is Microsoft and here is Apple. And you can decide, okay, how did the price move in the last 3 years? How did it move in the last year, in the last 6 months, and so on? And based on this, is it a better timing to buy Microsoft or Apple stock? And as I said before, the tool is very expansive and you can do a lot of analytics. Some of the ratios you're going to learn in this module will be available here as well, and we'll get back to TradingView. But this is just a general overview how to work with TradingView, how to visualize, how to analyze, and then finally come up with a decision if it's the right timing to buy, sell, hold, or do nothing in terms of investing. In this lesson, I want to briefly explain to you why it's so important to look at the previous performance of a certain asset. Here on the left, you see GameStop Corporation, which is an American video game merchandiser. And over the last years, the company was performing pretty badly from an economic point of view, and the stock price was continually declining. And so there was very little interest from investors to buy these stocks. But over the year of 2020 and especially in early 2021, participants on Reddit, the online forum, decided to work together and have a common effort to pump up the price of GameStop. And they really achieved this, as you can see here, that the price was rising within 2 weeks from about $4 to up to $480. So they collectively bought GameStop stock at the same time. And there were so-called short squeezes that all the people who were short on GameStop, so basically were speculating on falling prices, they were priced out the market, and you had this short squeeze and the price was just exploding into like nearly $500. But what I want to explain you here with the previous performance is that you should always look how a stock performed over the last month, over the last 6 months, over the last year, to avoid being the laggard and buy here on the top and sell on the bottom. because this is what happens to many people which are not doing their homework. So always have a look how a certain asset was performing over a monthly basis, over a weekly basis, daily, hourly, if you are into trading, so you can avoid jumping on the boat too late and getting wiped out by the market. So this is a pretty crucial concept for you to understand, that it's usually not a good idea just to follow the herd, but look at trading tools like TradingView, for example. Check out the previous performance of an asset and then come up with your own decision if it's a good timing to get into the market or not. So why is risk management so important? Here in this lesson, I briefly want to explain you the importance of risk management and how you can apply it in your personal investments. First of all, only invest the money you can really afford to lose. So check how much money you need for living to pay your bills, and then decide how much of your savings you're willing to invest in the markets. Build a diversified portfolio in terms of location, so choose US stocks, Chinese, European, and diversify your picks around the world in terms of location. Choose different industries and also have a good balance between value and growth stocks. This is especially true when it comes to regulations, because if you have all your eggs in one basket and then one governmental regulation is having a negative impact on this industry, your whole portfolio gets negatively affected. So really see that you have a healthy diversification all over your portfolio. An interesting approach what many investors are doing is so-called dollar cost averaging. That means that you choose a certain time per week or per month and you constantly invest the same amount of money. So once a month, for example, you can take $500 or euros and invest it in an ETF or an index fund or your stock of choice. And therefore you always take the average price of a certain asset if it's fluctuating, and you don't have to worry so much about timing. And last but not least, always do homework, do your own research when it comes to stock and crypto valuations, because as I explained previously in the lessons, you have to look at previous performance, you have to look at the ratios you're going to learn in this module and also the indicators. And please don't just blindly follow the herd, what you see on Bloomberg or CNN or other mainstream channels. Let's have a look at business cycles. Business cycle basically describes the expansion and contraction in aggregated economic activity. It means that within an economy, you experience a fluctuation of economic activity, and this is mainly driven by debt cycles. I explain you what debt cycles are in a second, but first of all, let's have a look at the economic measures. There are hundreds or thousands of different ratios and measures in the economy out there, but here I listed the four most important ones in my opinion. We have productivity. So what's being produced in an economy, what kind of products and services, what's the output within an economy. The employment, how many people actually get a job. The income, how is the income of these people developing, and also the sales and revenues in an aggregated area or in an aggregation of all the sales of all businesses. This is often referred to as a GDP of an economy. So let's have a look at the short-term debt cycle, the long-term debt cycle, and the productivity growth. What I would highly recommend you to do is to watch this video from Ray Dalio. It's called How the Economic Machine Works, and you can find it on YouTube. So short-term debt cycles basically last from 5 to 8 years. And they say that people borrow money in the short run to finance things which they can't fully finance out of their income. So you have an expansion of the economic activity, you have a contraction, you have an expansion, you have a contraction, and so on. And this is over a shorter time period of 5 to 8 years. And the summary of all these short-term debt cycles make up the long-term debt cycle. And after a certain period of time, there's just too much debt accumulated in the economy, and you need a so-called deleveraging, where you have a big correction, like assets get cheaper, stock market is correcting, and so on. An example I want to present you here is the housing boom in the US we've seen in the early 2000s. So there, in the 2000s, many people were borrowing loans. The interest rates were pretty low, and people were only like 2, 3, or even 4 homes because it was so easy to get a loan and buy a house. So over the time from the after the 2000 crash, the economy was recovering quite nicely and was rising to the tops, and everybody was feeling wealthy, buying stocks, having houses, and so on. But then in September 2008, when Lehman Brothers went bust and the whole economic or the whole financial system was on the brink of collapse, this was the beginning of the Great Recession. There was just too many debt accumulated in the US economy, and too many borrowers were failing to really deliver on their debt, and you had this domino effect going on, and the stock market was correcting by 50%, and all of these banks, or the majority of the banks, had to be bailed out, and the government was helping them. The central bank started to lower interest rate to 0% and printed a lot of money, and this is still going on today in the year 2022. And what I want you to take away from this lesson is that the economy is moving in expansions and contractions, and before you decide to make an investment in certain companies or stocks or areas, always consider in what business cycle we might in if we experience just a short-term recession, or if it's likely or we already headed for depression, or you think this is just the beginning of a great boom cycle we're going to have ahead of us. So this is the concept of business cycles in a nutshell. Relative Strength Index. What is it and how does it work? The Relative Strength Index is a pretty popular oscillator to give you an indication if a certain asset is overbought or oversold. Its reading goes from 0 to 100, as you can see here on the bottom. And the technical interpretation is if the RSI is below 30, an asset is being considered oversold. And if the RSI is above 70, it's considered being overbought. Let me give you an example here. In this chart, you see the price performance of Bitcoin, where we saw a peak in 2017 and a low in 2018. So when you look at 2017, where we hit the peak, the RSI was pretty high with over 80. Then it pulled back and moved into this normal corridor between 30 and 70 again. And then you had this major sell-off occurring here, where it went into oversold territory. And then back again into this corridor, and here, looking at this time scale, actually back to an overbought territory again. And the RSI is a very powerful tool to give you an indication if it's a good moment to buy or sell certain assets. Because if you would have looked at the RSI here on the peak in 2017, you could get an indication to say, okay, this asset is overbought, and it's not a good idea to buy right into the peak. While on the contrary, here in the low of 2018, when you recognize that the asset is oversold, that's always a good timing to buy assets. So as I said earlier on, the RSI is available on TradingView as an indicator, and check it out and play around to realize if your desired assets are overbought, oversold, or move in the corridor between 30 and 70. And come up with your decisions if it's a good timing to buy, sell, or hold your asset. In this lesson, I want to share with you what the income statement of a company is. So an income statement reports a company's financial performance over a specific period. So this is quite interesting to know as an investor, obviously, how a company was performing over a quarter, a year, or multiple years. Here in this case, I show you the income statement of Microsoft in the years 2020 and 2021. In general, an income statement consists of revenue, expenses, gains, and losses. And the total net income is calculated by the total revenue plus gains minus the total expenses plus losses. So if we look on the income statement of Microsoft, you see, starting on top, let's take the year 2021, the total revenues were about 168 billion US dollars, and the costs of the revenue, also often referred to costs of goods sold, have been around 52 billion, which means they made a gross profit of $115 billion, which equals an amazingly good gross margin of 69%. So revenues minus expenses equals gross profit. Then the next position is the operating expense, which is also referred to as overhead cost or selling, general and administrative costs. And if you subtract this from the gross profit, you come to the operating income. So we can also measure the operating income via the operating margin. And in the case of Microsoft, it's also very, very high with 42%. Then subtracting from the operating income all the tax obligations they're having and all the spendings related to the shareholders, you get to the net income, and you can also calculate the profit margin from there, which in the case of Microsoft is 36%. So they have a very healthy business performance, and this is a great way to compare different industry peers if you want to see how similar companies in the same industry are performing, and if the management is competent in actually delivering to the shareholders' expectations. What is the balance sheet and why is it important? A balance sheet reports on a company's assets, liabilities and equity at a certain point in time. The equation goes as follows, that the assets equal the liabilities plus equity. When we stick to our example from the previous lesson with Microsoft, you can see the balance sheet here, where the total assets are shown next to the total liabilities and the total equity of Microsoft. So if you quickly calculate in your head the total liabilities of 191 billion and the total equity of 141 billion, you come to total assets of 333 billion, and they always need to add up. I can give you a quick example here. Imagine you wanna, or in the case of Microsoft, they wanna build a new data center. So the data center is going to be an asset for them, which they put into the asset section. But to finance the data center, they go to the bank and they ask them for a loan, which is a liability. But once the data center is up and running and happy Microsoft customers are paying money, their cash holdings and therefore equity is going up, and adding these two together equal the exact amount of assets they booked in the beginning. The balance sheet is often used by financial analysts to calculate financial ratios like return on assets or return on equity. In this section, we're going to look at valuation methods for stocks and crypto assets. The 6 methods which are shown here give you a good overview how to evaluate if it's worth investing in a certain company or if you're already too late to get into the game. We'll start with the market capitalization and then also speak about enterprise value, the PE, like the price to earnings ratio, the PES, price to sales or price to revenue ratio, the growth rate, and also the network health in the case of crypto assets. Starting with the market capitalization, here we have to distinguish between stocks and cryptos. Basically, the market capitalization is showing you the market's view on the equity value of a company. And as I said, let's distinguish between stocks and cryptos. While at stocks, you have the total shares outstanding multiplied with the current price per share. So if a company is having 1 million shares outstanding and the price per share is $100, you have a market capitalization of $100 million, for example. Here on the top, you see the biggest companies in the world and with their current market cap. Like Microsoft currently is the most valuable company based on market capitalization with about 2.5 trillion US dollars. Looking at the crypto markets, here you don't take the total shares outstanding, but the total circulating supply of a certain token or coin and multiply it with the current price per coin. So when we look over here, we see the biggest crypto assets as of today. And while Bitcoin has a circulating supply of around 18,800,000 BTC, the price is about $60,000. We have a total market capitalization of about 1.1 trillion US dollars. And this is very important to distinguish here that stocks and cryptos need to be differently evaluated when we speak about market capitalization. And especially for cryptos, you have to always look at the total coins available, because this often dilutes the overall market capitalization, and you need to be very aware of this difference from regular real companies compared to crypto assets. Let's have a look at the concept of enterprise value. The enterprise value is the company's total value, including net debt. So you can think of it as that this is the overall price someone needs to pay to acquire the full company. In contrast to the market capitalization in itself, enterprise value is also including the net debt. The net debt is calculated by the total debt of a company minus its cash holdings. So if you look at the enterprise value, you also know about the health of a certain company, if they are mainly financed via debt, or if they have huge cash holdings on the balance sheet, and therefore also think about the risks associated with certain investments. For example, if interest rates are rising, how this company might be affected. And enterprise value gives you a good overview, especially for high growth companies, if they already generate a lot of revenues by their own, or if their growth is mainly financed via debt. In this lesson, I want to explain to you the price to earnings ratio, often referred to as the PE ratio. This instrument relates to a company's share price compared to its earnings per share. There are two different options how to calculate the PE ratio. The first one is that you take the market value per share and you divide it by earnings per share. Alternatively, you can calculate the PE ratios by taking the market cap of the company you want to invest in and divide it by the net income. There are two kinds of PE ratios, forward and trailing PE. Maybe let's start with the trailing PE ratio. This looks at the earnings over the last 12 months and then applies it to the market cap or the market value per share, depending on which calculation and equation you use. While the forward PE ratio is looking at the projected earnings going forward in the next 12 months. And this is a bit critical, because predictions are always kind of hard, especially when they concern the future. Now, jokes aside, the forward PE ratio is kind of risky, because the earnings of the company you want to invest in can change significantly. Therefore, you need to be a bit careful when calculating with the forward PE ratio. One thing I would like to mention here is that PE ratios only can be calculated if the company is actually making a profit, because otherwise you have nothing to put in the denominator. One tip or advice I would like to give you here is to also have a look at the price to earnings to growth ratio. This is especially interesting for high growing companies, since it's also having a look at the growth rate of the corresponding company. On the left side, I showed you the PE ratios, both forward and trailing, from mega cap companies out of the S&P 500, and just let's have a look together at some examples. Starting with Adobe on the top, you see that the trailing PE ratio is at 45 and the forward PE ratio is at 27. So analysts expect that the earnings of Adobe are going to increase and therefore decrease the forward PE ratio. Usually in the IT sector where Adobe is active, you have PE ratios from 20 to 30 maximum, I would say. So here Adobe has a quite rich valuation. Taking another example with PayPal. PayPal, the same story, that the forward PE is lower than the trailing PE ratio. So there as well, earnings projections are quite positive, and it's still high valued PayPal, but lower compared to Adobe if you look at the IT industry standard. One company I would like to point out here, Tesla, because this is a very hot stock and many people talk about it all the time. As you can see here, the trailing PE ratio is the highest one here in the round with over 180. So kind of an outlier. But this is mainly due to the reason that the earnings of Tesla are rather small compared to the overall market capitalization of the company. So the PE ratio is used quite often from analysts and investors to really evaluate a company. And I would advise you to also have a look at the PEG ratio and don't put too much emphasis on the PE ratio, especially if you invest in high growth startups or high growth companies which are not yet profitable. Price to sales ratio. Yes, in the last lesson we talked about the PE, the price to earnings ratio, and this is, as we learned, only applicable for companies which are actually profitable. So what to do with companies who make no profits? There, the price to sales ratio is an interesting instrument to use. This is a method for evaluating high growth yet not profitable companies. The equation is pretty simple. You take the market cap of a company you're thinking about to invest in, and you divide it by the total revenue made over the last 12 months. There again, there are two kinds of price to sales ratios, forward and trailing. Trailing, you look at the last 12 months, and forward, you project how the sales and the revenues over the next 12 months could look like. Here on the left, I listed some of the growth companies we've discussed during the exponential technology module. And we can have a look how they actually compare in terms of PE, but also PS ratio. Let me start with looking at the PE ratio in blue. And there you see companies like Beyond Meat, Cloudflare, Intelia or SunPower. They don't even make profits, so you can't apply the PE ratio here. But it's possible to apply the PS ratio to all of them because obviously they're making revenues. So if we look at Aptiv, like the electric vehicle company, which is developing software and security applications for electric cars, has a kind of a low price to sales ratio with 2. So that means it only would take 2 years for Aptiv to justify the market capitalization it is evaluated with. Beyond Meat with 6 and so on, and kind of similar single-digit numbers with the companies you see here. But there are some outliers like Cloudflare and Intelia, which means that investors are kind of optimistic about these companies. In the case of Intelia, gene editing, where we spoke about the gene editing module, that the potential disruptions due to this technology are amazing. And therefore, investors giving them some credit in advance, I would say, since the price to sales ratio with 150 is just extraordinarily high with Intelia. The same is true for Cloudflare, where they would need 50 years of constant revenues to justify the market capitalization. So looking at the growth companies listed here, I would say Cloudflare and Intelia are kind of overvalued, but the rest of them are really moving in a justifiable corridor. So this is a very interesting and very important ratio for you to apply as an expo-tech investor, because oftentimes in these areas companies are not yet profitable, but high growth and very fast growing. And there you can apply the P to S ratio to really come up with your own decision if it's worth to invest in certain companies. Let's talk about the growth rate. The growth rate highlights the maturity level of a company. So for every product or service, you can come up with a product or services life cycle. This is made up of 4 stages: the introduction of the product, the growth, the maturity, and the decline. So a product gets introduced, it's growing, it reaches a certain maturity level, and then the decline starts. There are important metrics and indicators like the revenue growth on a quarterly or annually basis, the growth of customers, users, and subscribers, and also if the company hires more people or on the contrary, people are leaving the company. Here on the left side, I show you Facebook, now called Meta, that their stock price since 2017 was still rising until today, while their revenue on an annual basis was actually declining. So what you can see here is that the high growth phase of Facebook seems to be over, despite they're still having very solid growth rate with double digits. But you see, while they had over 50% growth rates in 2016, this more than halved to about 20% in 2020. And this is a clear indication that Facebook reached a maturity level, and what I think personally is actually on the way to decline as a product or service. And this product or service lifecycle can be applied to every company you consider to invest in. And you can look at these metrics and indicators to decide for yourself if this company is still in the high growth phase, if it's in the maturity phase, or it's actually declining. Let's speak about network health. This is a very specific way to measure the value within crypto networks, and it's based on so-called on-chain analysis for crypto assets. What I show you here is Ethereum and Bitcoin and these specific blockchain indicators to really evaluate if it's worth investing to certain crypto assets. Something to keep in mind is that this kind of analysis is only possible for public blockchains where everyone has access to, and they are transparent in the way to display transactions, hash rates, and other indicators. So the most important metrics and indicators you can look at when you check out crypto assets like Bitcoin or Ethereum are active addresses. So how many addresses have been created within the network, how many addresses are active and then are interacting and are sending and receiving assets like Bitcoin. What's the difficulty or the hash rate? Here you see the mean hash rate for Bitcoin on this slide. And as you can see, it constantly was evolving with some ups and downs. But since the inception of Bitcoin in 2009, it was growing drastically. And the hash rate basically signifies the security of the network and the power which is necessary to actually crack the network or the mining difficulty there. And it's so high nowadays that basically no one is able to break it. Total value stake is a specific indicator within proof of stake networks. Ethereum, as we learned earlier on, are still in the proof of work consensus mechanism, but they are moving over to the proof of stake consensus mechanism. And for all staking networks, you can monitor or analyze how much value in either the native currency, in this case Ether, or US dollars is staked. Like in the case of Ethereum, you have all these DeFi applications like lending and yield farming and so on. And people are basically depositing their assets in a certain account to earn a yield on it. And this is what's called staking. And this data is publicly available on tools like Glassnode, what's a real front runner in on-chain analytics. And this is a measure you can look at when analyzing proof of stake networks. Also transactions per day, where you can see, okay, what is the activity within a blockchain network? Are there even transactions happening? Because if you analyze smaller coins, you will realize that there's no activity, and it's very likely that this is either a scam or the future perspective of the project is very bad. So also look at transactions per day, either in total numbers or in the value being transacted. And last but not least, you can also look at the fees, because as more transactions are per day, usually the fees are also rising. And especially in the case of Bitcoin and Ethereum, this could also cause some troubles, because if network participants have to pay too high fees for transacting with each other, this can lead to uncertainty and many people moving away from too expensive networks and look for cheap alternatives. One book I highly recommend you to read up here if you're interested in further ways of evaluating crypto assets is the book called Crypto Assets, the Innovative Investor's Guide to Bitcoin and Beyond from Chris Berniski. And this really shows you in great detail how to evaluate crypto networks and how to come up with the right decisions in which projects to invest in and which one to ignore. So let's talk about the asset research process. Here I visualized you 5 steps to think about the asset research process and how you can approach it as an investor. Starting on the top with the idea generation. So you read about a certain new technology or you heard about an interesting company and you have the idea to invest in this field, like in the industry, in the sector and so on. Then you start with your initial research and your exploration. As you saw earlier on, there are tools like FinWiz where you can look for certain industries and sectors and company sizes and so on. And once you found your desired company, you can do deep research and valuation. Basically looking at the ratios and indicators we explored during this module, and then come up with a decision if it's worth investing in the asset or not. Once you made a decision, you have to think about trade or investment timing and the execution. If you decided to invest in a certain asset, do you want to invest in it immediately, or do you think it's currently overvalued and you want to wait for a pullback and then pull the trigger and invest in it? And last, once you own the security, you have to do position and portfolio management, meaning do you want to invest a certain amount of money immediately into the asset, or you think about cost dollar averaging, that you want to put little chunks of money and invest them frequently over every week or every month, and then look on your overall portfolio, what kind of size this new investment has in your portfolio, and if certain other positions are getting too big and you need to rebalance your portfolio. So this shows you in a nutshell an easy to approach 5-step system how to do research on assets, and I hope you get a lot of value out of this.
Following characteristics of great investments. Here I put together 8 characteristics to give you a glimpse or some indications how to identify great investments. Starting with high operating margins. Great investments turn out to be companies which have very high operating margins. To give you an example, here is Visa, which has a very monopolistic position within the financial transaction market, and therefore has incredibly high operating margins and also delivered great returns over the last years to its investors. Stable demand or subscription-based business is also a good indication for good investments. Stable demand, to name here, is energy, food, or subscription-based companies like Salesforce or Netflix. Pricing power due to low competition. This is especially true for these kind of monopoly-like companies. If you think about Google or Facebook, they have very low competition in the case of Google in search or Facebook in social media, and can really increase their prices without all of their customers disappearing. So this is a very strong leverage they are having. And if you look at the stock performance of these companies, they have been pretty good and above average in the last years. Network effects, this is something we covered in detail in the module about digital platforms. And as you learned there, when a company reaches a certain network size, it's very hard for competitors to really get in the first place again and kick the king from the throne. So this is also an essential concept to understand. If you invest in companies which already has or is about to have strong network effects, this is a great indication to receive great returns. Leveraged assets, if you think about Airbnb or Uber, which both don't own any physical assets, but rather leverage them with their technology, with their software platforms, they also grew very rapidly. In both cases, they delivered great returns for venture investors. How the returns are going to develop in the public markets is yet to be seen. But there are multiple other examples where companies are leveraging assets and therefore are more agile and faster moving than their competitors which actually own physical assets. Strong brand, this is pretty self-explanatory. To give you an example here, Apple built a very strong brand over the last years and is still building on this brand and being able to sell a commodity like a smartphone for more than $1,000. Category leaders goes in the same direction, like pricing power due to low competition. If certain companies just nail the niche and they are the absolute category winner, if you think about Amazon in the e-commerce sector, it's very hard for other companies to really compete with them, and therefore they become more and more powerful and also turn out to be great investments. And the last point, high returns on invested capital. This is an indication which is also interesting to look at. How the management is actually allocating the capital of the company and what are the returns of this invested capital. So in summary, if you look at all of these 8 characteristics and you come across companies which cover all of them, or at least most, then it's a very good indication for you to really think about investing in this kind of companies. Shape your edge to outperform the market. Here, I want to show you 3 skills which I personally think are super important for you to succeed as an investor in the long run. Starting with behavioral excellence. I think this is one of the most important things to really know how to play the mental game and have your emotions under control. I personally do a lot of information and read up on personal development and spiritual books, how to really calm down in stressful situations. And this is what's also like distinguishing the successful traders and investors from the one who are failing. Because as we learned over the last 100 years or 150 years since the stock market is existing, that we've experienced multiple boom and bust cycles. And there's a famous saying from Warren Buffett: when people are greedy, you should be fearful. And when people are fearful, you should be greedy, which means that in times of market crashes, when everybody is pulling out and selling in panic, these are oftentimes very good opportunities to get into the market, but therefore you need to be in balance and also have behavioral excellence. Informational advantage. It's very important that you know where to consume your information from, and I personally recommend only to have a handful of trusted sources where you get your information, because otherwise you get overwhelmed. In this day and age with social media, unfortunately there's so much BS out there, and people are just trying to read everything all the time, and this just leads to confusion and bad outcomes. So I personally only have a handful of magazines or traders and investors I'm following, and and I'm not blindly copying them, but get influenced and then do my own research to verify what they think, and then decide to buy or sell certain stocks, for example. And technical skills, for you as an investor, it's also very important to know how to read charts and spot if a certain asset is overvalued, if there's like bubble territory already, or if you think it's undervalued, and it's a good time to get in. And also apply indicators like the ones we learned during this module, like the RSI, the relative strength index, or also look at the growth, the annual growth rates over the last years and so on. Or if you invest in crypto, that you look at network health, and to really anticipate what could happen next, or how the long-term growth trajectory looks like by being able to read charts. So I think if you master all of these three skills, you have a great path in front of you as an investor.
Hello everyone, here in this video I want to do a live demo asset evaluation with you. So basically picking an asset and then doing an analysis if it's worth to invest in this company. Here, starting out with Finviz, the stock screening platform we already learned earlier on in this module. And here, as we saw, there is this stock screening function. I click there, and then I say I'm interested in the technology sector. And within the technology sector, I'm choosing the industry, in this case, software infrastructure. And then I can also choose the market capitalization of all the companies I'm interested in. So in this case, I choose between 10 billion and 200 billion. So here I have a lot of different companies, and I can check it out, what seems interesting to me. There are even 2 pages. And I say, okay, let's have a look at Block, former called Square. So click on there, we see the chart first and see that over the long run, the company was developing quite well. But last autumn, starting in November, there was a pretty ugly sell-off. And it seems like there could have been the bottom in over there. And there was a big bounce. So yeah, let's dig deeper and do some research here. So Square, or now called Block, has a market capitalization of 74 billion. And the income is rather low with 160 million, but very high sales with 17 billion. So we have a kind of high PE ratio, since the income is pretty low compared to the market capitalization. But interestingly, if you look at the price to sales ratio, it's just at 4. And this is exceptionally low for a software company, because usually they tend to be between 15, 25 or even 30. So Block has a very low price to sales ratio here. When we look at the previous performance, we see that especially over the last year or the last half year, the stock was selling off pretty dramatically. But last month, and especially this week, we saw an interesting bounce back. Also interesting to look at are the margins. So the gross margin with 25% is genuine, and the operating margin and profit margin is rather low with just 1%. But it's already a profitable business, and it's a scaling game in my opinion. So the more customers they are acquiring, the more profitable they're going to become. So I think this could be really interesting to invest in Block, and in the next step I would like to look at the chart in more detail, and therefore we use TradingView. Also stock analysis or other asset analysis tool, what we got to know earlier on. Here in the search field we type in the ticker symbol SQ, and then we get the chart of Square here on a weekly basis, and we see they went public in late 2015 and were developing quite well since then. If we look on an percentage field, so you see they went public in 2015 and their investors were sitting on gains of 10x, about like nearly 1,000% returns, since Block went public in 2015, 2016. So what I'm interested here is to see, okay, how is the stock from a relative strength index point of view? Is it overbought? Is it oversold? So therefore we have a look at the indicator section up there and we search for the relative strength index. And as we can see here, after the big drop due to the corona shock, it was pulling back pretty heavily. And then over multiple weeks have been actually in overbought territory. And here finally the sell-off happened. And over the last couple of weeks, Square was even oversold. So now with this rebound, it's going back in the regular territory between 30 and 70. And this, in my opinion, would be a good entry point again to consider investing in Square. Another thing I'm interested as well as an investor is the growth rate. So how have the revenues been growing over the last years? Here you can look at a quarterly basis and an annual basis. But me being a long-term investor, I'm more interested in the annual growth of the revenues. So checking out the annual growth here, we see that the growth rate is still amazingly high, especially from the year 2019 to 2020. They were jumping all the way from 42% to over 100% growth rate year on year. And in 2021, still amazingly high growth rate with 85%. So Square, if they keep on this trajectory, they still have a lot of growth in front of them. So I think it's a very interesting stock to invest in. And then finally, thinking about the fundamentals and if it's really if it's having the great characteristics we've been speaking about as well in this module. And what I came up with is that I think Square has a stable demand, since their customers always want to send or have to send money around, exchange money, pay their rents and so ever. So the demand is pretty stable. I also think that Square has great network effects. Just putting this on top here so you can see it better. They have good network effects because the more people join the platform, the more attractive it gets to the other people to join as well. So Square is built on these network effects. And when you remember earlier on, we said that the operating and profit margin is only 1%. But if they have enough customers and pretty low customer acquisition costs, they can become super profitable in the long run. I also think that Square is using leveraged assets. So basically everyone with this supercomputer in the pocket, which is called the smartphone, can use the Square app, the Cash app. And therefore it's very easy for users to immediately start using their services. And the last point, what I think that they already built a strong brand. This is also due to their CEO, Jack Dorsey, former CEO of Twitter, who is kind of a popular figure in the business world. And he managed to build a strong brand in the US with Square, and which is called Block now. I'm still saying Square. And what I also found out on my research, that they want to expand their workforce in Europe. So I expand that Europe is going to be one of the next big markets they are entering, to grow even further and generate even more revenue than they're already doing. So in summary, I think it's a great company to invest in, and based on the technical analysis and also the margins and the ratios we looked in this point in time, I would put some money on the table and invest in Block. So I hope this live asset evaluation was helpful for you, and you can, you got some value out of it, and you can do your own analysis on the company you are thinking to invest in. In this lesson, I want to share with you the 5 biggest stock exchanges in the world. Starting on the left with the NYSE, the New York Stock Exchange, which is the biggest stock exchange by daily trading volume all over the world. The New York Stock Exchange is often better known as the Wall Street. Next, the NASDAQ. NASDAQ stands for National Association of Securities Dealers Automated Quotations, and this is like a tech stock exchange, so there are many technology companies listed, and in general more growth stocks and risky companies to invest in. And yeah, some people say that the regulations on the NASDAQ are not as high as the New York Stock Exchange, but this is open for interpretation. In Europe, we have the London Stock Exchange, which is one of the biggest exchanges in Europe. There you have a main market with over 1,000 listed companies, and an alternative investment market where you can buy products like ETFs and bonds. The Euronext is the biggest exchange in Europe. It's located in Amsterdam, but has offices in Milano, in Lisbon, in Brussels, in Oslo, and in Paris. The Euronext is considered the 5th largest stock exchange all over the world. And then the Tokyo Stock Exchange in Japan is considered the 3rd largest stock exchange in the world and the biggest one in Asia. And this is important for you to consider when you want to invest in certain companies, in which geographical location they are, and if they are listed on these and one of these exchanges. I would say that these 5 exchanges I show you here, they cover like the majority of the most well-known companies in the world. And in the next lesson, I'm gonna share with you what kind of online brokers are existing to buy and sell stocks. On this slide, I want to show you 3 online brokers where you can invest in stocks. Starting with Interactive Brokers, this is the largest electronic trading platform in the US by daily trading revenue volume. In there you can buy stocks, options, futures, forex, and bonds. Fidelity Investments is a quite old company. They have been established in 1946. Very big asset manager, and they offer brokerage services for stocks, index funds, insurance products, and interestingly also cryptocurrencies. eToro is an Israeli social trading platform. What this means, I'm going to explain in a second. And they offer trading and investment services in stocks, commodities, indices, forex, and cryptocurrencies. Social trading means that you can follow other investors, copy their style of investing, but also get followers by sharing ideas. There's like a news feed where you can share your investing and trading ideas, and then people can get aware of you and follow you, and you can get even paid by this. So these are 3 household names which are pretty well known in the area of online stock investing, and I would say they are covering like 90 to 95% of the most common companies which are publicly traded. You made it. Congratulations on finishing all of the 12 modules of the Expo Investing course. That's a fantastic achievement. I'm sure you learned a lot along the way and that you are now confident to go out, take action and apply all of the acquired knowledge in the financial markets. Looking back at our common journey, we started by looking at the fundamentals of investing and together discovered what kind of asset classes are out there. Then we moved on to learn about exponential technologies, why they are growing so fast, and what exciting investment opportunities they hold for you as an investor. Climate tech, blockchain and crypto, AI, gene editing, digital platforms, and edge computing. You are now familiar with all of these technologies, and you're also aware of value and growth stocks in these exciting areas. In the expansive module 11, you get valuable insights on tools, metrics and ratios to apply, so you can build your own stock and crypto valuation models. This rounded off our Expo Investing course. I really hope you enjoyed the course and that I could meet all of your expectations. Once again, congratulations for finishing the course and taking your valuable time to do so. I wish you all the best for your future.